Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. We've had a couple more days of down only. We'll talk about the Bitcoin price chart, where it sits currently here on your screen. We'll also look at some past capitulation events in equities and compare them to now in our own unique way. We'll also talk about the housing market as well as household debt. So don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up and subscribe to the channel. We've got over 14,000 subscribers, which is unbelievable. I cannot thank you enough for your support. Now let's get into it. Well, we finally got our move below 20,000. In the previous video, we talked about how likely it was that we would take a swim below 20K, down below the all-time high from 2017, and that it was time to shatter some narratives, that we need to crush mythical beliefs. Things like Bitcoin can never go below the previous cycle high are the kind of illogical beliefs that a lot of Bitcoiners instilled in themselves, based their investment theses on, and begin parroting out whenever price looks weak. People have come to believe that just because Bitcoin is decentralized, just because it has a fixed terminal supply 100 years from now, that for some reason that means it can't perform like other assets, that it's going to do magical things. And that's simply not true. And we need to dispense with these beliefs because they're not grounded in anything. While I don't relish pain, I don't wish for people to lose their fortunes, I don't wish for anyone to undergo stress, for the long-term health of Bitcoin, it's important that we break these kinds of beliefs, that we just go down and go ahead and squeeze that one right out. Let's get rid of it, let's dispense it, let's move forward. Because there's no mechanical reason why the price cannot go wherever it must go to find balance, and it will do that. And I think that in a small part, the belief in that narrative, the belief in the narrative that it can't go below there, added fuel to the necessary nature of it happening. Enough people believed it couldn't happen that we had to go and prove them wrong. The market has one job. That is to extract value in the most efficient way possible, which usually means it is the path of pain for the most participants. The path of pain is rarely up. It's typically sideways or down. And this little move right here was ripe for the taking. Now, what I'm not so sure about when I look at the formation here, I don't really know with true confidence that this is a bottom, right? That this is some kind of a structural bottom where we're never going to come back down here again. It's hard for me to come on here and say that when I have expressed many times now that I don't believe Bitcoin or crypto is going to bottom on its own until the economic situation starts to smooth out, until it starts to look a little bit less hairy and a little less doomy. Now, I do believe that because of the free market nature of Bitcoin, that it is likely to find a bottom before equities and other markets, whenever that is, but I'm hesitant to say that this is it. Perhaps it is. Perhaps we can manage to just kind of creep sideways for a while. That's certainly possible. I mean, we did it here, we did it here, right? We could have another long stretch of dancing around down here in the 20s. As a long-term investor, I would welcome that because it gives me an opportunity to get a bunch of Bitcoin below 30,000. But what we can't say with real confidence right now is that this is a bottom. I know that there are fractal kings out there like my buddy Blockchain Backer who have done a lot of work trying to identify whether or not this is a bottoming structure. And I'll leave that kind of granularity to those experts, where my focus is a little bit on the bigger picture. And my thesis is that markets will not begin to find a bottom until we have reached a period of greater deterioration. So let's use a couple of examples. The first example we'll use is right here. So I tweeted this out about a week ago, 2 weeks ago, and this is a look at the stock market with tickers that are setting new highs versus tickers that are setting new lows. So I made a ratio up here at the top in this black line. Now it's a bit of a noisy ratio, but what I really want to focus on are the lows. These are periods where the number of tickers that are making new lows far outweighs the number of stock tickers making new highs on that given period. And if you see back, these periods are usually around, market lows for those periods of time. Now, one thing that jumped out to me when I was looking at this chart is that we haven't really gotten down to these lows yet, right? We're still kind of up here in this middle range. It's hard to say that when you've gotten one of these little peaks, one of these dives down below, it doesn't always indicate that that's the pico bottom of the market, but it can suggest a period of capitulation. So if we look back here in 2008, 2009, we dipped down, but that wasn't the end of the market. The market continued down lower, and we had a couple more of these prints. You can see it's a little thick right here because there's 2 or 3 of these peaks down inside this circle, and they kept occurring as the market moved lower and lower, and more tickers capitulated. So we're kind of looking for something similar over here, just based on history over the last 15 years or so. Now here's what the chart looked like most recently. I had to take a picture of this because for some reason TradingView wasn't loading the data correctly today. But lucky for us, I took a picture of this a couple days ago. You can see this is from June 16th. So it's about a week after my tweet here on June 10th. So on June 16th, look, we made a little dip. You see this? See how it fell down? If I go back to my original tweet, here's the line up here. We haven't really broken below the 2022 low at the point of tweeting here. But in the most recent updated version of the chart, we've printed a new low for 2022, and we're getting close to these previous lows where there were a bunch of tickers that set a new low for themselves. So maybe this is a sign that we're getting close to a period where we could see some upside. Maybe it isn't sustained. Maybe it doesn't go for very long. Perhaps Bitcoin is already beginning to do that a little bit as we're seeing this curl here off of 20. Now it's a market holiday today. Equities are closed, but they open tomorrow and they'll get an opportunity to respond to everything we've been seeing. So maybe we're getting close to a capitulation on equities. It's hard to say. And with the economic situation being so uncertain, with the expectation that we'll probably begin seeing higher unemployment, that we'll probably have to see at least 1 quarter of pretty ugly earnings. Some of those things haven't really unfolded yet, and those could lead prices lower. So I'm not calling bottom here, but just from a purely historical perspective, we're getting near a point where we could say we are aligned with historical capitulations. So that's one feather in the cap of maybe we're near a temporary bottom. We can't call legacy bottom yet until the economy turns around. So another way that we can try to corroborate whether we've seen a bottom or not is by comparing the S&P 500 to the unemployment rate. They are intrinsically linked, particularly when we have an economy that's powered by the American consumer. I've showed you this chart before. This red line up at the top is the percentage of consumer spending power that makes up the gross domestic product. It's about 69%. It's well over 2/3 of our economy is powered by the consumer. So when the consumer begins to weaken, when they start losing their jobs, it affects valuations and revenues, and it brings the stock market down. So what we've got on the chart here, the top line in black is the S&P 500. The line at the bottom is the unemployment rate. The red vertical lines are market bottoms. The blue vertical lines are the peaks of unemployment. And when you look at the sequence of events, these gray vertical bars are recessions. And when you see the sequence here, what really jumps out is that the red line is virtually always before the blue line, which means in this case that the market bottoms before unemployment peaks for that cycle. Something also worth mentioning is that on every one of these instances pictured on here, the market low did not arrive until the unemployment rate had risen at least 50 basis points from its low, at least half a percentage point. If you look through history, that has happened every single time. The market low has come in while unemployment has already risen. Low, unemployment risen. Low, unemployment risen. It happens every time. And then unemployment peaks later on, right? It grows for a period of months. Sometimes it grows for over a year or two. And it eventually finds a peak after the market has already bottomed and has begun to somewhat recover. So the sequence of events that we're most likely to see based on this lens right here is that we can anticipate unemployment will probably begin to rise at some point because we are in a major economic downturn. And it just makes sense that we will see unemployment begin ticking up. And it's most likely that the market will not have bounced until unemployment has risen at least half a percentage point, perhaps more than that. In many cases, it's far more than that. In some cases, it has risen 2 or 3% before we actually get to the low of the market. And if we look over here at recent times, friends, over at the very end of this line, we zoom in for you. The unemployment rate has not begun to tick up at all yet. It has barely begun to move. So my concern at this time is that we are not yet near a place where we would have reached a market bottom. And I think there's a relationship here between the market itself and the people in charge of the money, right? So the Federal Reserve is very focused on unemployment as one of their mandates to maintain full employment. And since unemployment is a lagging indicator, it's one of the last economic indicators to warn you of trouble. It makes sense to me in a way that the market bottoms before unemployment hits the top, because it's moving on a lag. It's moving slowly. And the people in charge of the money often continue forward with their plans until their chosen lagging indicators give them invalidation. And by then, the economy's already in the shithole. So I think that through this particular lens that we're exploring here, I believe we've got some more room to go before we can call the bottom of the market. And this is based on, 60, 70 years of history, going back into the middle 1950s. It's given us a bunch of signals. And I don't believe that this outcome will be that much different from the others through this particular lens, through the lens of unemployment and the stock market. So we did explore, perhaps we're near some kind of a capitulation low. It's hard to say exactly, but this ratio is getting near extremes seen in the last 15 years. But at the same time, it appears that the market has not bottomed, because it usually does after employment has started to rise, and it has not risen yet. Maybe we begin to see it tick up over the next month or two. Once we enter July, which is Q2 earnings season, we might begin to see a precipitous rise in unemployment. As companies begin revealing their Q2 numbers, they'll probably be ugly in a lot of cases. Certain sectors will probably hit really hard. And that could be a time where we start to see a rise in initial jobless claims. So that is something that I've got my eye on here as we go through the next few weeks. And something else that I really want to explore is the housing market. So we've been talking about a lot of different facets of the economy on the channel here, and one of the ones we've been focusing on is the housing market. So I'll leave a link in the description below to one of my previous videos from about a month ago where we unpacked weakness in the housing market. We talked about rising inventories, falling sales rates, and the likelihood that we would see price drops, in part because a 30-year fixed rate mortgage is over 6.5% in the United States. It is more than doubled in a period of about 7 months. So what we've got on the screen here is a chart of active listings for Austin, Texas metro area, which is one of the #1 hottest markets in the United States. Each of these lines represents a different year over the last 4 years, and the black line is the current year, 2022. So up at the top, we've got active listings. At the bottom, we've got active listings year over year. So comparing now to the same point last year. What you can see is the black line is rising very quickly. Now, these are active listings in one of the hottest markets in America, and the number of homes that are available for sale at any given time is increasing. So it is rising very quickly, and it's coming from a low. And if you look at 2021 here in orange, it really started to decline, and the amount of homes available for sale at any given point really started to tighten in the second half of last year. In about August and November, this line started coming down. But we're seeing now it's rising very quickly. And on a year-over-year basis, it's the highest jump that we've seen in over 4 years. So one of the hottest markets in America is seeing a rapid rise in the number of homes available for sale at any given point. The quickness that they were leaving the market is slowing down. Demand is beginning to wane. This view here is of listings with price drops. So these are the active listings. These are the active listings with price drops. What do you see? Well, if we look at 2022 again, the total yearly number of listings with price drops is higher than any point it's been in the last 4 years for one of the hottest markets in America. This is a clear sign of a cooling market. And for it to be rising this quickly, for active listings to be rising this quickly, when mortgage rates are at 6.5%, suggests to me that the cool down in the housing market could be swift, friends. I'm not an expert in this market. There are others perhaps listening to me now that have more experience in real estate. But purely from a rate of change market perspective, this is a sign of a rapidly cooling buyer demand. Just to make sure it's not isolated to Austin, let's also look at Phoenix, Arizona, which, like Austin, is one of the 5 hottest real estate markets in America. What do you see here? Rising active listings. Now, the rise is not quite as swift as the one in Austin, but every market for real estate is highly regionalized and independent. They're unique. They all have their own kind of quirks and dynamics and demographics. So they don't all look identical, but the trend here is very similar. Over the last few months, rising active listings on a year-over-year basis. It's the highest level it's been in 4 years. Also, price drops in Phoenix, Arizona look much like the price drops chart for Austin, Texas. Quickly rising percentage of listings with price drops, in part because of the exorbitant interest rates, but also because valuations are sky high and the consumer is being squeezed from all sides by generational inflation. So I believe that there is a swift repricing coming to the US housing market. I don't know what kind of a percentage we're looking at, how long it takes to play out. I'll try to do some more study. Maybe I can come up with a better idea, but just purely looking at the data here, looking at the rate of change, looking at a couple of key metrics, it really shows us that this market is cooling off. And I think that it extends beyond just housing. I believe in part it's because the consumer themselves is being massively squeezed. They're employing a lot of debt, and they're reaching a point where the savings that they've piled up are being whittled away by rising costs, and they're forced to make discretionary decisions. Here's an article from the Wall Street Journal just from last week that says more subprime borrowers are missing loan payments. As we explored in one of my previous videos, there are small, subtle hints that delinquency rates are rising across the consumer basket in mortgage debt, credit card debt, auto loans, you name it. Delinquency rates are softening and beginning to rise from previously historically low rates. But when we're in the climate that we're in, when we have 40-year high inflation, there's serious concerns that even a small rise in delinquencies can quickly get out of hand. And one of the reasons I'm concerned about the debt is because it appears that it's going in the wrong direction. We've explored on the channel before how total public debt, that's debt that's held by the federal government, is around 125% of GDP, down from over 130%. But household debt also appears to be rising, and it appears to be going the wrong way. So this metric is updated on a lag. It was last updated in Q4 of 2021. So we don't know what the new values are, but we do know a couple of things. That GDP contracted in the first quarter of 2021. So the denominator of household debt to GDP got smaller. We also know that consumer credit is on the rise. It's been swiftly rising since last year. It has broken above the COVID highs, and consumers are deploying more and more credit. Credit cards represent debt. So we've got rising consumer credit while also having a contraction in GDP for Q1, minus 1.4%, which means it suggests to me that when this value updates of household debt to GDP, that it may break out above this level here and begin a trend in the wrong direction. We do not want to see households taking on more and more debt as a percentage of economic output. Not in this environment, especially with rates where they are. And I think that it's a product of the fact that consumers have to deploy credit, particularly those lower on the income spectrum. They have less flexibility. They have almost no savings to their name, and they are forced to pay for things with credit cards, which puts them into a negative feedback loop that is extremely difficult to get out of. Here's a look at two different types of household debt. So what I've got here on the red line, we've got total household debt year over year. The blue line is total household debt year over year, excluding mortgage debt, right? So I've taken the home debt out of it. So the red line, as you can see, has been on the rise since 2010. It's been rising pretty swiftly. Even though there was a little bit of a hiccup here in 2020, it took another huge jump. This is household debt rising, the nominal level of household debt. Now the blue line represents that same value, but we take the mortgages out of it. And you can see just here recently, there's been a little divergence, right? This is actually coming down, but you can see the red line is rising. So mortgages are part of that. But just checking the trend, just seeing how both of these are growing, both of them are at pretty high levels. And if we're seeing like the nominal amount of revolving credit card debt on the rise here, I have to imagine this value will continue updating higher. And it's reaching a point of breaking out above 15-year rates of change. So I am concerned that households are reaching a point of serious stress. And when you look at total debt, public debt, private debt, all debt combined as a percentage of GDP, it's over 350%. It's currently around 370% of GDP is the total debt in the United States, both by the federal government and in the private sector. So as a society, we are continually leaning more heavily into our debt and getting less economic output for it. On a more micro level, households themselves are deploying more and more credit at a period of 40-year high price inflation, at a time when mortgage rates have essentially doubled in 7 months, when short-term interest rates are at 10 and 12-year highs. Now is the time that we're seeing consumers deploying more credit. This really does not feel like a tenable situation to me. High rates and high inflation should be a period of time where debt is coming down, where it's getting whittled away, but instead we're seeing the opposite effect. So when we talk about all those things, when we talk about rising household debt, particularly as a share of GDP, when we look at the housing market and we see rising active listings, we see rising listings with price drops, those are really showing that one of the stronger parts of the economy is beginning to cool considerably. And when we see the S&P as a relation to the unemployment rate, it really suggests to us that we've got some more length of time to go here before we can call bottom. There must be some more deterioration before the people in charge understand that their policies are leading us down the wrong path, because they have chosen flawed and lagging indicators to guide their decision making. So in part, we're kind of along for the ride here. In the interim, Bitcoin is just dancing around 20,000. I do believe that at some point, the chances are that we go lower than this, simply because of everything we've unpacked and explored today. I don't know where that price is, but if we look on a high time frame level here, this is our current support level. The next support level is down here around 13.8, around 14,000. That's because that is the monthly close from 2017, and it also aligns pretty closely with the high from 2019. So on a big picture, high time frame level, there really isn't a lot of support down here. So if we actually get back down below this level, perhaps before the end of the June monthly close, then I would anticipate some more time spent below this line here at 20K. Make sure you follow me on Twitter at TXMC Trades. That's where you'll find a lot of my thoughts, my intraday analysis, and my market observations. The market is closed today. Tomorrow it opens after a long holiday weekend, and we'll see how equities respond to the volatility in the crypto market over the weekend. If you enjoyed this content, please make sure to give my video a thumbs up and subscribe to the channel. Your support means everything for me, and it helps YouTube to promote my channel, knowing that you guys enjoy the content. I will be traveling this week and next. I have a little bit of content to come out while I'm gone, but I mostly am going to try to stay away from the charts. Hopefully nothing timely unfolds while I'm gone. You'll have to forgive me for not providing quick analysis if that happens. I haven't taken a real vacation in 2 years, and I plan to make the most of this. Until my next video, I hope you all have a wonderful week. Take care of yourselves, be kind to each other, and we will chat along the way. Cheers, everyone.